We got the CPI today, and we're going to get to the fundamentals of that and other things in a minute. But first, I want to focus on the technicals because we discussed them yesterday. And I'm not a technical analyst, but I think the technicals are particularly important and particularly telling right now. So we've been bearish for a little over a week. And Friday of last week, we had a very interesting market. We had a market that went up, went down, went up, went down. It was somewhat volatile, and we didn't like it. Monday, yesterday, we had a market that just continued to sell off from futures being green to closing at the lows. The market just gradually continued to go off. And today we saw a similar thing. We had the CPI data, the market spiked, it came down, it tried to spike again, came down, tried to spike again, came down, and then finished the day on a slight spike, but still well off the highs and in the red, which it didn't get to towards the end of the day. So that leads us to the question, and this is the big question: where is the incremental buy? And this has been a question that is posed a lot. I hear this question a lot on CNBC, but I haven't heard it a lot recently. I heard it a lot in a low rate environment, which we are no longer in. Rates are up significantly from where they were, and I expect them to go up even farther than where they are now, possibly another 100%, another double in rates from the current levels. So, what differentiates right now from when I heard this term in the past? In the past, where the incremental buyer is a significantly easier question to answer. It's who can borrow the next dollar. And in a low rate environment, everyone can borrow the dollar. If you can borrow money at 1 or 2%, 3%, whatever margin rates are, yeah, you'll just borrow more money and buy some stock. That makes sense. If you do the math, it makes sense. However, now that rates are going up and the effect that has on the stock market, the calculation just doesn't work. The math just doesn't work. So where's the incremental buyer? Well, it goes from the person who can borrow, which is lots of people and, plentiful, and they're always doing it, to no one. It's the opposite. Now you've got the incremental seller because you've got rates rising, you've got bonds becoming more attractive, so you've got people having risk-adjusted stocks become less good investments relative to risk-adjusted higher rate bonds, and they sell, and that becomes the calculation that's appropriate. So stocks have to adjust in order to find an incremental buyer. So this is a phenomenon that I think is going to become more and more important. The only way to find an incremental buyer is going to be to lower the price because bonds are going to get more expensive. And I think that's the long-term dynamic, and I think we're seeing the short-term dynamic playing out in the technicals, in the charts, in the slow drawdowns, the just continuing drop, and that's just the way it's going to be, in my opinion. So we're going to see how that plays out. We're going to allow it to play out, and we're going to be adjusting accordingly. We've been playing the downside. We're happy. We are doing well, and we were doing well even when the market was up. We were still also up. So I encourage you to continue watching this channel if that says anything. Anyways, CPI. The market rallied on the CPI. What is up with that? Well, car prices are down, used car prices are down. Okay, I guess that's a good thing. But I'm bearish on the CPI. One, I don't think cars are a necessary good for the next 2-3 years. I think everyone who needed a car or needs a car has a car, and that is a one-time purchase. Sure, if they come down 10%, that's going to be great for someone who gets into a car accident. But let's do a quick calculation. So inflation was up 1.2% month over month, and wages were up 0.4% month over month. Inflation is going up at a faster rate. Wages, the rate of change is going down. That's not good. So actually what happened is consumers' ability to purchase products and contribute to GDP on a consumption basis went down. Goods, necessities, etc., their expenses are now taking a larger percent of their wallet. And 0.8% might not sound like a whole lot. It's only 0.8%. But if you multiply that by 12, you're getting an almost 10% impact, which is quite large. And that's right now. So, okay, well, maybe inflation is peaking right now. Sure, I could see that happening because used cars are falling, and it's possible they're going to continue to fall for a couple more months. However, what does not seem to be the case is that Ukraine is planting a bunch of wheat. There's a small period of time in which they can do that. They're not doing that. What does not appear to be the case is that Russia is going to put a lot of fertilizer and energy into the market. It appears all countries are shutting off trade, or virtually all countries are shutting off trade with Russia. And I don't see us getting any of their fertilizer. So fertilizer prices are expensive. Look at Mosaic. We've written a Twitter piece about that a while ago, last summer. Look at that stock. That is reflecting high fertilizer prices. So food, which comes from fertilizer, and a lot of energy actually is involved in farming. This is concerning. This is not telling me that inflation is going to go down. I think in terms of daily, day-to-day spending, it's going to stay high or continue to rise. So that's an important factor. Consider the fact that wages are not accelerating at the same rate anymore, and we don't have something to be all happy about. Okay, this is the recessionary situation, in my opinion. I'm not forecasting, major economic calamity that we don't see or anything. What I'm forecasting is simply, one, obviously raising rates and the impacts that has, but more importantly, that inflation is going to cause a hit to consumer wallets. We're seeing that in the 0.8% disparity month over month between wages and inflation. So we'll see what happens there. And obviously CPI is, people say inflation is higher than CPI. There are arguments for that, particularly rent, because it's only homeowners equivalent rent, which is a very strange calculation. They ask rent or landlords, etc., whatever it is. So I'm not optimistic about the CPI. It's high. I will get optimistic when it rolls over, but it's not doing that. And as we discussed yesterday and in past videos, Friday as well, it's probably not going to do that until we get beyond the neutral rate. Maybe it'll start to slow, but it won't necessarily roll over, etc., until we get to the neutral rate. So we really got to get rates up. That's just the way it is. I think a lot of people are in denial about that, and I don't blame them, because we've had a Fed and in a period that warrants that kind of situation. But the Fed, it's really so that's what they should do, right? They have to hike rates, and they're talking and they're adjusting. They've gotten rid of the word transitory, so they've gone away from the thing. But they've had to make this shift. Think about this. The Fed is supposed to be independent, and it's sounding like they're trying to reclaim their independence right now. But last year, we had a new president. And guess what he did 6 days after his inauguration? He appointed a former Fed chair to be Treasury Secretary. Doesn't necessarily scream independence. So we'll see what happens. But I've laid out my case. I've laid out my things to think about, navigate them. There's a lot involved. It can get very complex. So feel free to ask questions. Happy to answer. Happy to provide additional context for next video. So that's today's video. And until next time, peace out.